Thanks everybody for joining us for Wealth Webinar. This webinar is very simple. We're going to go over some simple things when it comes to your money. We're going to show you, number one, how to take back control of your money, because I know you might think you're in control, but you are not. The system is. Today, I'm going to show you how to take back that control. And I'm going to show you how to do that by teaching you how to be the bank, how to be your own banker. And there are a couple things as I'm going to go over here. I'm going to go back to the basics today, something brand new. We're going to go over control of your money. We're going to go over the certainty when it comes to your money and controlling of your money. We're going to talk about liquidity, one of the single most important things. You don't believe me liquidity is important? Then why does Warren Buffett with Berkshire Hathaway have over 30% of their assets in cash right now? Over $381 billion, because they understand liquidity. And today you're going to understand that. And most importantly, I believe, is efficiency. We're going to get back to efficiency of money. Money can be complicated. I get it. I was a financial advisor 16 years. We still have a registered investment advisory, PMC Wealth, where Stefan and Brandon take care of people's financial advice. But I will tell you, it is very easy to make money complicated. And Wall Street, banks, and the institutions, trust me, they want you to think money is way too complicated for you to understand, so that you do exactly what they've taught us to do: take your hard-earned dollars and give up control to the institution, so they then can use your money, make your money work for them, and make the magic spread or fees. But let's get into infinite banking concepts. What is it? A lot of people hear the word. It's not new. That's the first thing I want you to understand. The concept has been around since 1999. The late R. Nelson Nash pioneered this after long nights on his hands and knees praying to God for a change, for solutions to his massive money problems, and it came to him. It came to him at about 4 in the morning when he was on his knees praying, and this is called the infinite banking concept. Let me be very, very clear what infinite banking concept is not. It is not a product. We're going to talk about a product, but it is not a product. It is a process that you will apply in your life. And that process does one thing and one thing only. And I want you to be clear about this. Write this down, grab a pen. The process of the infinite banking concept allows you to take back the banking functions in your life. In other words, it allows you to take back all the interest and all the payments that you give away to the banks and the institutions. All of that will be yours. It will not be fast. This is a marathon, but every day it will be better, and every week will be better, and every month you'll have more, and every year you are guaranteed to have more than you did the year before. Hence, certainty. But let's get into the bare bone basics. All of you have one thing in common. You make an income. Now, I don't know how you do it. Maybe you're out there side hustling. Maybe you got a W-2. Maybe you're salary. Maybe you got a business. Maybe you got a combination of several, including passive income. You have an income. One of two things happens with that income. You either spend it, and all of us spend our income. There's no way around that. Sorry, folks. But we spend that money on things like our living expenses, all the different things we need to go through the day and live and provide for our families. And we also spend it on the debts that we have accumulated, the car loans, the student loans, the mortgages. You get it. That is the spending. Now, I'm pretty sure if you're here, all of you also save money. And that savings can be in many different forms: 401ks, savings accounts, money market accounts, doesn't matter. You save money. Now, you can look at my little guys here. If any of you remember that movie, One Crazy Summer, I used to draw them when I was a kid. This is a common exchange. And I just wanted to show that just as a common exchange. Money is nothing more than a means of exchange. We take the money we earn and we exchange it for goods and services. We exchange it for things, but we always try to save some of that money, and that savings is for future needs. Could be retirement, could be an emergency fund, but could be some purchase you're saving up for. But let me be very crystal clear. Everything you do in your life, you finance. Your capacity for finance in your life is greater than anything else. So remember, the infinite banking concepts is a process allowing you to take back the banking functions in your life. If the banking functions include financing, and everything we do in life we finance, well then, wouldn't that be a really powerful thing to take back control of? But many of you didn't understand what I said, so let me just unpack that. Because all of you are like, well, yeah, Chris, we finance our cars. Like we take loans or we do leases. We finance sometimes things we buy, like our house, maybe our furnishings, but we don't finance everything. Chris, I pay cash for things. Man, I save up money and I go out there and I pay cash for things. That's not financing it. But see, that's where you're wrong. You do finance it because you're always paying interest in one of two forms. So let me discuss paying cash for something. You have money in savings. Just imagine this money's in savings. You want to buy a new couch for your living room. Okay. You take the money from your savings account or your checking account and you go and pay cash. You think you're done. But that money you paid cash, call it $1,000 for that couch. That money will never work for you again. It will never earn for you. So indeed, you did pay interest because you gave up the interest earning potential on that money you had in the savings. This is very important. Nobody's going to teach you this. Nobody's going to explain to you the opportunity cost that we have with money. Now, what I'm going to pose to you is a solution where never again throughout your life, by changing just one thing and adding one step, never again will you lose the earning potential on the original dollars you save. The money you save will continue to work for you and earn for you 24/7 for the rest of your God-given life on this planet. It will never not earn. And the best part is, even when you're gone, it will still continue to work for you at an even higher velocity. That's pretty powerful, isn't it? How much money do you think people would have if the first dollar they ever saved continued to earn uninterrupted compounding interest for the rest of their life? How about your children, right? When we have children, and we're going to get into the next form of financing, but when we have children, I have a 5-year-old, we teach them how to ride a bike. We've all learned how to ride a bike. But for those of you that did, it starts just like it is for my daughter, Vivi. We bought her a bike, tiny little thing, and had training wheels. We teach her how to ride that bike, and it's very simple. Pedals go down. We teach our children that as the momentum of our pedals, our pressure on the pedals, that means the bike goes forward. We very quickly teach our children that when they step back on the pedal, that's the brake until they have little hand brakes. We teach them that with the training wheels, when the handlebars get turned to the right, the bike goes to the left. When the handlebars get turned to the left or to the right, the bike goes to the right. You get the point. But then eventually we have to, and this summer is the year for me, take the training wheels off. And when we take those training wheels off, what happens? Well, I'll have Instagram videos of Vivi crashing and burning. Yes, she'll have her knee pads and elbow pads and helmet on, but she's going to go down. No ifs, ands, or buts about it. You all went down. And Ricky's wife, when she gets on that bike, she's going to go down too. Part of learning. But we got back on that bike and we pedaled that bike and we made it work. The reason I say that is I want you to think of that training wheel analogy. Imagine the money that you're saving for your kids, for their future, for their college, for their first car, for their whatever, their graduation fund. Imagine that money goes into an account where it earns uninterrupted compounding interest, and some of that interest is guaranteed. And then imagine that throughout life, your child needs to use that money, and they take that money out and they use it for various things, but the original amount, all of it, continues to earn without any interruptions. What do you think that would mean for them later in life? It would mean a lot. So when I talk about financing everything in our life, you're either giving up interest on the money you save, or you are paying interest in the form of a payment to somebody else's bank. We are going to solve both of those problems because we're going to take that control back. You will never, if you follow what you're going to learn today in this training, you will never, ever not earn interest on every single dollar you save, regardless of whether that money is still in the account or out being used for something like buying a car or furniture. Secondarily, in the future, and maybe now, you will never need to rely on the banks, ask the banks for permission for using their money, which is your money. See how I did that? Tricky, huh? It's your money, folks. You make deposits in the bank. The bank takes your money and makes it go to work for them. They make a spread on that money. They make your hard-earned dollars that you gave up control of because you deposited it in their bank, and they make that money go to work. And look up BauerFinancial.com. The bank makes 400 to 1,300 more than you did. All I'm trying to do is help you understand in your mind what's really happening. Now let's solve the problem. That change that I had mentioned, because there is just one change you have to do. We'll take all of that and put it all in your favor. So that one change is this. We're going to change where that money goes first. We're no longer going to start by taking our savings. I'm not talking about all your income, folks. I'm talking about just the amount you save. Maybe the amount you're putting in the bank account for the rainy day fund, the Christmas fund, the new car fund, the college fund. That is the money we're talking about. We're going to change where that goes. You see, we're going to put that money in a place where the wealthiest families throughout history have put their money. Those, namely, the Rothschilds, the Rockefellers, the Morgans, the Stanleys, Ray Kroc, Walt Disney. I could keep going. They all have used exactly what you're going to learn, and they put their money into this account. Now, before I tell you what this account is, let's just talk about the benefits, okay? Let's just talk about the benefits of this account before I tell you what it is. First off, just let me know if you guys are okay with this. This account pays you guaranteed interest that never changes from day one. So if they guarantee you 3% interest on your money, that is what you're going to earn for the rest of your life. Is anyone not okay with a guaranteed interest rate on their money for the rest of their life? You can put no if you're not okay with that. Okay, good. I'm pretty sure all of you are okay with that. Love the guarantee. Okay with that. All right. Secondarily, you're going to participate in dividends. So every year, this is not guaranteed, but they've never missed. Every year, they're going to pay you a dividend. They're going to share some of their profits with you in the form of a dividend. Anyone not okay with getting a dividend check every year? Because there's no reason for us to think they're not going to pay a dividend next year or anytime in the future, seeing as though they have paid dividends every year, even through the Great Depression and Great Recession. They've never missed. Everybody's okay with dividends. Okay, good. We're on a good start here, Craig. The dividends and the interest that they pay you are going to grow tax-free. Is anyone okay not paying the government taxes on your gains? I know some of you on here just love your business partner called the IRS, and you love making tax payments. Okay, protection. So how about this account where we put the money, it's going to provide you protection against judgments and liens in most states, and it's also going to be private. Meaning you never need to tell any government agency, not the IRS, nobody, how much money you have in there. It's no one's business but yours. You okay with that? Cool. It's going to provide control in the sense that you're never going to have to ask permissions. It's going to provide efficiency because you're always going to earn interest and dividends no matter what. And it's going to provide certainty because it is, again, guaranteed. Everybody's okay with those. There will be no volatility because it is not correlated with the stock market. Zero volatility. It can only do one thing, and that is go up. There is no restrictions on you taking money from it. When you need money, you just tell them where you want the money sent. And the best part, and this is going to blow what it is, the best part is you are going to have a death benefit when you die. I know some of you are like, I don't like my family. I don't want them to get anything. Well, we can arrange for that death benefit to be pretty close to nothing. But there is going to be a death benefit that will be paid out tax-free to your family so that it self-completes when you are no longer here. Now, the other thing there's going to be is if any of you get sick, maybe a critical illness, a chronic illness, and you need some money, we're going to have like a liquidity pool of money, the death benefit, that you can just tap into to help pay for some of that care if you can't do the activities of daily living. So listen, I know that wasn't all that much, but I'm just saying by changing one thing, that's what you're going to get. Now, let me just tell you what this place is. It is nothing more than a dividend-paying whole life insurance policy from a mutually owned life insurance company. Now, this is a specially designed and engineered whole life policy. This is not a normal whole life insurance policy that you would buy from an agent or an advisor. It is custom designed for high early cash value, which requires the agent, us, or your advisor, to reduce their commission by 60 to 90%. So unless you can convince your agent or advisor to literally give up their commission and give it back to you to the tune of you're going to make 60 to 90% less working with me today, well, then you might want to just call us and we'll give you a link where you can meet with us. We can discuss this and we'll build it so that we take the haircut on the commission, and we're okay with that because that's just what we do. Cool? Now, that's only where the story begins, because all we did there is changed where the money went to start. But that is just the beginning, because the money is never going to just sit there, because again, in your life, you have a greater capacity for finance than anything else, because you're going to need to buy things. But you see, we're going to stop looking at buying things or debts as bad. We're going to look at them as a ginormous opportunity. Have any of you ever looked at your debts and been like, honey, look at these debts. Those are the greatest opportunity for us to build wealth I've ever seen in my life. I fucking feel like I'm going crazy. That is crazy thought, right? But what if I told you it is absolutely true? And I will prove it to you today. Because today we're going to demystify loans. We're going to demystify how these loans from these policies work. That is going to be the main topic. But again, let me finish this infinite banking concept. I'm just having too much fun with this. So because the opportunity zone includes financing, lending, paying down debts, which is your biggest opportunity, because it is the greatest way and the fastest way for you to build wealth for your family, is your own debts that you have today. Business uses, investments, real estate, it's infinite. We can use it for anything. But this is what our goal is the opportunity zone. There are only a couple rules. The rules are we have to change where our savings goes first. It goes into this silly whole life insurance policy, but that whole life policy gives you every one of those things I just mentioned. Then what we're going to do is we're going to flow the money, and I like this word, flow the money, from that specially designed whole life out. We're going to take that money out, but we're not going to do it always. We're only going to do it when we have an opportunity for our money to work for us in the capacity of financing. Remember, financing is two things. Financing is either the money that you're paying to someone else's bank, we're going to take that back. Or in the future, we're going to just finance things that we need to buy, and we're going to make payments back to ourselves. That's one. Or number two, things that we want to buy, we're not going to use money in the bank that takes a withdrawal out and stops the flow of interest. We're going to just continue to earn that interest. So we're going to flow that money out. Now, this is what today's topic is going to be, is this magic thing that everybody is misconfused about, is loans. Loans. Wait a second, Chris, hold on a second. Craig, you two, I'm going to throw you in the pot. You want me to change where my savings goes, and then you want me to borrow my own money? And I'm sure if I borrow my own money, that insurance company is going to charge interest on that money, right? Of course they are. Yep, that's exactly what we're telling you. Now, I know that's going to confuse all of you, and I don't want to explain that, because that's what the rest of this training is going to be about. But let's just continue. Let me just tell you this. I'm going to tell you that, yes, that's what you're going to do, because your money is going to continue compounding at a rate, at a velocity higher than the amount the insurance company is going to charge you to use your money. Let me just pause. I want to put this into perspective. This is super simple. All of you know of somebody or yourself have a home. Now, that home over the last 10 years has done one thing, and it has gone up in value. I don't care where you live. In 10 years, your house has gone up in value, which has created equity. Now, some of you are smart enough to go in and take a home equity line of credit to use that equity in your house to go make more money a second time. You understand that. When you use the money from your equity in your house, does your house continue to go up in value? I mean, if you're in an appreciating market, yeah. So let's say your house was worth $500,000 today. You have $100,000 in equity that you're using, but next year your house is worth $600,000. How much equity do you have to use the next year? $200,000. But because you used the equity didn't mean the house stopped appreciating. You all understand that. Everybody understands that. That's what we're talking about here. But what we're going to be able to do here is a lot better than what you can do with a bank and a home equity line, because your money is going to earn a higher velocity, a higher interest rate than what it's going to cost you to use it. And here's the thing. We're going to make that even faster. And here's how we're going to do that. The money from the loan comes over here, and it goes into a bank account. We're going to have you set up a segregated bank account. Very simple. Go to your bank, open up a second checking account. You're done. That's it. Tell them you don't want a debit card. You just need a second bank account. The reason we do this is, I know, because my wife and myself, we're guilty of this. If you use your traditional checking account where you pay all your bills, that traditional checking account acts like a black hole. At the end of the month, there's nothing left in it, or very little. That's just how they work. Sorry, I don't know why, but don't do that. Open a second segregated checking account, and that is going to be for your private banking activity, or the infinite banking concept. Now, what we're going to do is we're going to then flow that money that we put from the policy into the bank over here to the opportunity zone. We're going to do things like pay off debts. We're going to do things like private lending. We're going to do things like take loans for opening businesses or expanding our businesses or doing marketing our businesses or buying equipment for our businesses. We're going to do investments. We're going to do real estate. Whatever you want to do, we are literally going to go in and we are going to use this money for something over here. Now, here's the only rule. This is the only rule. If the insurance company charges you 5%, and this is not an ironclad rule, this is just a simple rule, okay? If the insurance company charges you 5% simple interest to use their money, notice how I didn't say your money, because you're not using your money. The insurance company in the loan provision, which we're going to get into, allows you to use their money. Effectively, they allow you to take some of your death benefit while you're living and use it. That isn't your money. That's money they promised someday when you die. But they let you use it while you're living. And there's only a couple rules. And the rule is you have to have enough cash value to collateralize the loan. That's it. Kind of like your home equity line. You need to have enough equity to collateralize the loan the bank gives you. Same idea. So now it's clicking. The rule is if the insurance company charges you 5, which we have insurance companies charging less than 5, but I'm just using 5 as a simple example. We have to use that money at a higher interest rate than 5 because listen, this is quite simple. If you're going to be a bank, act as if you are a bank. I don't know a single bank in the world that will pay you 3% on your money that you deposit there and charge you 2% on loans. That's backwards. They will pay you 3 and charge you 4, right? Or 5 or 6. They're always going to make a spread, and you must make a spread. And that spread has to be positive. So in other words, if you have any debt, credit card, car loan, student loan, at a rate higher than 5%, it's game on, baby. We're taking the loan from the policy. We're going to use the insurance company's money while our money continues to compound. We're going to use it to pay off the debt that is a higher interest rate than 6. And then here's what we're going to do. This is the single most important thing because you cannot steal from your bank. You can't steal from Bank of America. You can't steal from Ally. Then why would you steal from your bank? I said 3 to 5 minutes. I'm way over on this. Here's what you do. If you paid off a debt, okay, and I don't care what it is, whatever it is that you finance, whatever your business use is, investments, whatever it earns, let's say it earns 6%, and let's say that 6% is $500 a month. You are going to recapture that exact same amount. You're going to take that $500 you used to give to Visa, Ally Bank, whatever, Bank of America, and you're going to pay that $500 a month over here to your segregated account, goes into the bank, and then we're going to recycle and recapture that 500. We're going to take it right over here and we're going to put it back into your policy. Your cash flow didn't change at all. You're saving the exact same amount you're saving today. You're spending the exact same amount you were before, but you're taking back control of 100% of the money because you're not giving it away anymore. It is not leaving your family anymore. But there's also something else magical happening behind the scenes. Your money is uninterrupted, it's compounding uninterrupted. Your money continues to build. You didn't lose the opportunity cost anymore. And your money is also making a spread. As a matter of fact, depending on the way we look at this, your dollars that you put into the policy are making money for you twice, not just once anymore. You are earning twice on the same dollar. This is the infinite banking concept, folks. It is very simple, but it is a complete shift in how you look at money, which is why it's complicated. So now what I'm going to do is I'm going to kick this into overdrive and we're going to talk about the loans. That's why I kept talking about them here. We're going to talk about the loans and we're going to demystify the mechanics of policy loans. And we're going to show you how the loans that you're taking from the insurance company are indeed a good thing. You are absolutely on the right side of this. I know it sounds like a swear word, loan, but you see, you don't need to call it a loan. I have to tell you a loan from compliance reasons. You can call it whatever you want. You have access to your money without using your money. Easiest way to explain this, and Craig's got a great drawing, is think about it this way. This entire system works because you're not using your cash. You are using the insurance company's cash. You are using a contract, the whole life contract, and provisions in the contract that allow you to use the insurance company's money. And folks, they got lots of it. They're not banks. They're insurance companies. And by regulation, it requires them to have all the money sitting in a surplus account called their general account to pay all those death benefits someday in the future when we die. You think that's a lot of money? Well, we have one insurance company that's over 100 billion. Yeah. So when these insurance companies have $100 billion of money sitting there, do you think they want that money to go to work for them? They do. What better way than to allow you to use part of your death benefit while you're living? They charge you interest, but you see, here's the best part. If your policy's paying you 6 and they're charging you 5, make sure you understand that. If your policy were paying you 6, hypothetically, and your policy allowed you to borrow at 5, let's just put that into normal thought. Imagine going into your bank. You put your money into your bank. Your bank paid you 6% interest. Anytime you wanted a loan, you didn't need to fill out a loan application. You didn't need to tell them what you're taking a loan. You didn't need to provide financials or tax returns. You just say, hey, listen, bank, I need like 20 grand today. Can you lend me 20 grand? But you guys are paying me 6. Can I borrow 20 grand at 5%? And the bank's like, yeah, sure. You'd think you died and went to heaven. You're like, this isn't a bank, this is heaven. This is the same thing. But let's get into exactly how this works, because you're borrowing against the insurance company. You're borrowing from the insurance company against your death benefit. That's it. That's the only negative. If you took a loan for 20 grand from your policy and you die tomorrow, your family will get $20,000 less. That's it. Because they gave you part of your death benefit today. Craig, I'm going to give you the ability to pull up some slides. Let's dive into demystifying the loans that people take to perform the infinite banking concepts. Shauna is kind of like my boss. When Shauna says do something, I do it, folks. So I am obliged to tell you about an event that we're doing next week. Now, I'm not obliged. I want to, because this event is pretty epic. It's called the BYOB. So that stands for Be Your Own Bank Blueprint. That is happening next week. Now, you can get tickets here today, okay? And I've got a really cool special. I haven't done this in a long time, so I'm really excited about this. But let me just kind of tell you, next week, I should say, Thursday, Friday, and Saturday, it's a 3-day event, and it is recorded. However, next week, we're doing this training. This is one of our best trainings we've ever done. We keep making it better. We keep making it improved. And I want to invite all of you, but I want to give you something, at least a couple of you something. And next week, March 26th to the 28th, you can join us for 3 days. Now, if you can be there in person, just get the GA ticket. They're super cheap. They're $47. That's all you need is the GA ticket. But for some of you, you're like, oh, crap. I got my daughter's play. I got my son's soccer game. I can't make it. No problem. We record it, edit it, timestamp it, and we do that for the VIP members. So it's a little more expensive. It's $97, but you get all the recordings, okay? It's a hell of a value. $47 or $97. Here's my offer for you guys today. I love skateboarding. I still get on the board. Vivi rides the board. We made these boards. These are really high quality. Penn's Wood is the manufacturer. You don't need to be a skateboarder, but think of how cool this would look on your wall. Okay. This is an old remake of a classic skate graphic. Okay. And this one is a BYOB deck. These decks sell for $66. Okay. That's how much we would sell them for. For the first 2 people that buy a VIP ticket today, which the link is right there in the chat. You can see Shauna just posted it. For the first 2 people, I'm going to mail you a deck. And I might give a couple more away. I'm only committing to 2. Okay. So on record, I'm only giving 2 away, but you know what? From time to time, I'm like, let's give a couple more away. So if you buy the VIP ticket today, and it has to be today, you might get a deck. The first 2 are definitely getting a deck, but I might feel like giving a couple more away. But you know what? I want to show some love for some VI or for some GA tickets. So we've got a bunch of shirts. I just grabbed 1, but I got a bunch of these. I might give away 5. I might give away 10. For any of you that buy GA tickets, and you got to be the first ones, for however many I decide to give away, I'm going to mail you a shirt. Now, I might not have your size. So here's what I'm going to need. If you buy a shirt today, what I need you to do is I need you to if you buy a ticket today, a GA ticket, and VIPs, remember it's the deck, but the GA tickets, the $47 ones, I'm going to send you some shirt. I don't know what it's going to be. Could be a hat, could be a beanie, could be a shirt. It's a mystery box. You're going to get something. And all I'm going to need is you to give us your address. So if any of you go to that link right there on the chat and you buy today a ticket, a GA or a VIP, I'm going to need your address. So could you please email Shauna at chrisnaugle.com your address. You don't need to tell us what you bought. We'll go in and look, and we'll basically send you the appropriate thing. Okay. Some of you might get this one. There's only one of these left. This is it. This is a vintage money school V-neck shirt. This is a small, so somebody's going to get that one, but I got a bunch of stuff. So anyway, that's my offer for you. Join us next week for the BYOB blueprint and get some cool swag and mystery boxes in the middle. All right, Craig. Sorry, I had to get that out of the way.
Yeah, it is very important. All right, so I'm going to go ahead and share out my screen here. We're going to talk about the loan process, and what Chris just walked through is kind of that whole flow of the money. And what I want to do is talk about that same concept, but we're going to use buckets, and we're going to talk about the policy components. What do I mean by the policy components? So Chris had mentioned the tool that we're using for this process is a specially designed whole life policy, and we want to reiterate how some of those functions work within the policy. So we have these things called premium deposits. Think about where your savings is going today. Chris talked about that could be going to 401ks, that could be going to savings accounts, that could be going to money market accounts. And what we're talking about is redirecting or putting those savings into a different tool, such as the specially designed whole life policy. So now think about all of the savings that you're putting into this premium deposits bucket. This is the money minus some expenses that's going to be compounding for the rest of your life. There's only one direction that the money in this bucket goes, and that's up. So we're going to be, because we have those guarantees, Chris talked about the guarantees, that means we're going to be increasing our account value year after year after year. And then there's also the non-guaranteed dividends. So this is the bucket where we want to fill up as much in there. So now there's another bucket that we want to talk about, and you can call this the cash value. It's really just a ledger value in the system where think if you had $50,000 of cash value, and that means that we have the ability to take some of that. That's our collateral, that we have an ability to take some of that as a loan. So if our cash value is 50,000 and we take a $10,000 loan, who can tell me how much more cash value I have available to take as a loan? So if I have 50,000 total and I take 10, how much cash value do I have left to remain as a loan amount? Anyone put that in the chat if you know the number? So 50,000 is my total. I took 10. Yep, 40,000. 40,000 unsure, but you got it. You're exactly right. That doesn't mean that I only have 40,000 compounding. It just means that's what's available. Okay, so we talked about the 40,000. Now what happens if I pay that $10,000 back? What happens to my available cash value? It goes from 40 back to the 50. So I want everyone to think about this cash value ledger bucket as simply the balance is going to be going up and down the rest of your life. It's going to go down when you take a loan. It's going to go back up when you repay the loan. This is working kind of independently of how much is actually compounding, because remember, everything else is compounding. We're just leveraging, and this is showing us how much we have available to leverage. Okay. The next bucket I want to talk about is the death benefit. And the death benefit, and Chris had mentioned earlier, if you had a $20,000 loan and you had, say, $500,000 of death benefit and you pass away, or we call it graduate, what's going to happen is the insurance company is going to say, all right, you had $500,000 of death benefit. We're simply going to take the 20 that you already used and pay the rest to your family. So now the death benefit is actually what's kind of giving us that ability to get some early use of that death benefit. And I just want to make this very clear because there's some confusion out of all the strategy calls that I've done, our team has done. We've noticed a pattern. So here's a question for the audience. If I have $50,000 of cash value in my ledger and I have a death benefit of 500,000, can I take a $500,000 loan? Who thinks I can take a $500,000 loan? Ricky says no. Kathleen says no. Well, all of you understand this, but we do have some folks that get confused thinking, well, if I have a $500,000 death benefit, that's what I can borrow. No, you're all correct. The answer is no. What I have available is the cash value, that ledger amount. Right, Warren's got it. It's only the 50, it's a percentage of that 50,000. But now when we take a loan, is that coming from our pile of money or is it coming from what we call the life insurance general fund? Chris had shared with you these companies have very large general funds. Unlike a bank, so let's say you go down to your local bank and you put $1,000 in your bank account. What the bank's going to do is multiply that and pass it out to people with car loans, home equity loans, whatever that's going to be. And so the insurance companies also have a pile of money, but I'll tell you this, as a mutual policy owner, if you take a loan, they can't go put that money to work elsewhere. So they have a dollar is a dollar at the insurance companies as opposed to a dollar being multiple dollars in a banking system. So that's another big difference of what's going on here. But I wanted to share these buckets because if you can think logically about the different buckets, we have premium deposits. That's where our savings is going. That's going to continue to compound uninterrupted for the rest of our life. The second bucket is the cash value ledger. That's going to go up and down. That balance is going to go up and down. I have a little gas gauge on here. So the same concept. We fill our gas tank up, we drive, it goes down. We fill it up, it goes down. So just know that that cash value number is going to go up and down as we take loans and pay them back. We have a death benefit protecting that loan, and our money is actually coming from the life insurance's general fund.
The only thing I want to point out, and I think it's really important, is I want to give a disclaimer that there was no AI used in the making of these buckets. I thought that was really important.
So anyway, just kind of back onto the buckets. If there's any questions on these, please let me know. But I am going to move on and talk a little bit about the loan processes and how the money flows. Okay, so here's the first step. You need $10,000 because you're going to buy, I've talked with some folks that have landscaping companies. They needed a $10 to $12,000 lawnmower. This could be a home improvement. This could be whatever it is. Chris had mentioned the possibilities are infinite. But what happens when you want to request a $10,000 policy loan? So, Chris, I know you've taken lots of loans, I've taken loans. When we do that, how many questions do we have to answer? What do they want to know? Our
There is
income,
a
tax
goofy one.
returns?
It asks you, is this part of a divorce decree? To which I always put no. And then it asked me what bank account I wanted to go to, which I have it already in the portal. And it asked me how much. And I think there might be one other question, but I don't remember what it is. So it's not important.
So what you're saying is when you request a loan, there's very minimal questions. They don't ask when you're going to pay it back. They don't ask what are you going to use this money for.
Nope, no tax return questions, no personal financial questions. Yeah, no, they didn't want to see anything. They just wanted to know where the heck they could send the money.
And this is one of the things that I sometimes see people getting stuck on is, well, wait a minute, if I take that $10,000, I can go buy crypto, I can buy a car, I can buy a lawnmower. They don't care because if you remember back in those buckets, remember the death benefit is backing up that loan. If you don't pay that loan back and you pass away, they're just going to take it off your death benefit. So the first really important thing to know about our own banking system is they're not going to put big hurdles in front of you when you want a loan. It's just how much do you want? Where do you want it sent? Now take that, the money's coming from this life insurance company's general fund. And what we're doing is we're saying, hey, dump $10,000 out of that bucket into my bank account. This is the segregated bank account that Chris was talking about because we don't typically want this money mixed in with our daily operations of groceries and gas and credit cards and all that stuff. So we typically have a separate account. There's nothing magical about it. It's just another account at your bank that's going to be the place where we move the money from the insurance company into our bank account. So now we're pouring money into our bank account. From there, we can go do whatever we need to with it. We can buy the lawnmower, we can go on vacation, we can buy the new door for the house, windows, whatever it's going to be. So then the next question is, and this gets into a little bit of situational loans in the cases where you're using your infinite banking system for debt pay down, a lot of times what we'll do is we'll take the loan and just like velocity banking, we'll chunk away at our debts. So we'll take the loan and throw it at the debt that may have the highest interest rate or the lowest balance, just depending on the structure we come up with. And in those cases, we may not pay back our loans until we get some of those debts cleared, and then we'll pay back the loan. But let's use another example. If you took a loan because you're going to go buy a car, or you're going to do a home improvement, or maybe it's even a medical emergency, what we want to do is structure repayments back to our system. So if I'm taking a car loan, it's no different than going to a bank and getting a loan. Well, they require monthly payments. Or if I go to the car dealership and they give us a loan, well, they want monthly payments too. So why would we treat our banking system any differently than we treat somebody else's? So when we take a loan, we're going to go buy that thing. Let's say we're buying that car, start making loan repayments back into your system. Now, there's two different pieces of a loan, right? There's in a loan, you'll have principal, you'll have interest. If you look at your mortgage, you're going to see some of your payment goes to principal, some of it goes to interest. If you have a HELOC, those are typically simple interest, so your payments are going to principal. This is a really, really key piece of loans that I want to make sure everyone's listening. So when you make a loan repayment during the policy year, 100% of that loan repayment is going into the principal reduction.
That does not happen with the home equity line of credit. I want to preface that. I don't know any other account anything that does this. I mean, you literally get full access and full liquidity of every single recaptured dollar you put into the policy, because the insurance company only charges interest one time per year, and that is on your policy anniversary. So I'm not going to say you get 12 months free, but you get 12 months of no payments that allows you to buy down the APR on the loan, which is critical. It's almost a cheat code, Craig, because it allows you to literally cheat the insurance company out of interest money, and it allows you to increase your spread every single month without changing your cash flow or losing any control of your money. Sorry, I didn't mean to steal the thunder.
No, I mean,
I
absolutely.
got a little excited.
It's a really, really good point that we have to make sure everyone understands before we move on, because the interest on the side account, so you see that bucket with the interest and there's a circle going around, that interest is going to be calculated based on the remaining principal. So just think about it. The lower our principal keeps happening every month, every day, that interest is over there accumulating, but that movement slows down. It's going to be accumulating slower and slower. So the more we throw in the principal bucket, the less interest we're actually paying to the insurance company. So that is a really important thing to remember. The faster we pay it back, the less interest goes to the insurance company. Now, let's just say we are now at the policy anniversary. And a policy anniversary is not on a calendar year, it's not on your birthday necessarily. Think of a policy having its own birthday. So if I started a policy right now today and it funded, well, every March 18th is going to be my policy anniversary. At that policy anniversary is when the insurance company is going to say, hey, Craig, you have an outstanding loan, and throughout the year, I know you made loan repayments to your principal, and maybe I took a $10,000 loan at 5%. Most people would say, well, $10,000 of principal at 5%, that means I have a $500 loan interest, right? That's the 5% of the 10,000. Well, the insurance company might come back and say, well, actually, your loan interest is $285. That's because we bought that principal down, and now they're just saying this is the remaining interest. So here are my options. I can say, you know what, life insurance company, I don't want to pay my interest. And what they'll do is they'll take that interest accumulation, they'll dump it into the principal. So now if my principal balance was $7,500, it's just going to go up based on the amount of interest that I just added to the bucket. Okay. So I have an option. I can pay the interest out of cash, or I can just say I don't want to pay it and it goes right into principal. How I've been doing this for many years is I just let that interest keep getting poured back into the principal, because my objective is to get more of my money into the principal reduction and then just have it go into the interest bucket, have the interest
It's
bucket.
really all the same in that case, right? It doesn't even matter. It just makes it automated.
It actually makes it automated, but there's a mathematical benefit to doing it that way, because if you're setting, yeah, Chris is like, you probably have a spreadsheet for that. I
But
absolutely
you don't
do.
need a spreadsheet anymore, because now you got the Vault software, which is your operating system. It just does all the work.
Yeah, and I used to do spreadsheets, now we use the vault, but there is actually a mathematical advantage to paying the principal down as opposed to setting it aside and then waiting for that anniversary to pay the interest. We can prove the math out on that, but those are the options you have at your policy anniversary is do you want to pay the interest or not? Now, let's say that you choose to pay the interest. This is what the money looks like is you're going to go from your segregated bank account and that month, you're still going to make your monthly principal payment, but now you're going to pay your interest, some or all of it. It's completely up to you how much you want to pay towards that. So let me know if there's any questions on the loan repayment. We're going to show some of the math for some of the people who love to see the numbers. We're going to get to that, but I just wanted to get these concepts out first.
You were
I
talking
don't
more
under
about One America and how they do it reverse. They charge all the interest up front, but then over the year they calculate it.
Yeah, so
It's
some
the same outcome.
companies. Yeah, it's the same net outcome, but One America, for example, they'll put the full amount of interest on the balance at the start, but then it comes out in the wash if you pay it off. So they're just showing interest up front, where some companies don't.
Yes. So Warren, think of it this way: if you took a $10,000, I'm just going to use hypotheticals. You took a $10,000 loan from One America, and One America charged 5%, which they're a little under that right now. Just think of that as like there'd be what would that be, Craig? Oh my God, I just forgot what I just said. $500 in interest? Is that what it would be?
If
Five,
it's
10,
if it's 5% of the
yeah,
10,
500.
they would charge the 500 up
So,
front, and
so
then
what you would see is a loan balance of 10,500 because they technically calculated the interest for the whole year. But then let's just say next month, and I know you would never do it this way, but next month you paid the $10,000 back. What they would do is a kind of a calculation. So you would only got charged 1/12 of that $500, and the rest they would have just adjusted it on the statement or on the portal. It's kind of goofy how they do that. It makes sense why they do it from an accounting standpoint, but the net at the end of the day, no matter how you run the math, is identical if the company charges the interest upfront or at the end, because it's just simple interest calculations.
Mhm.
It is a
Correct.
bit wonky, Warren, and it's a bit kind of like a shock when you see it. But just know if you do everything we're showing you and you follow the process, which is just be an honest banker, then the net outcome at the end is exactly the same.
Yeah. And I'm going to shift gears a little bit because we've taught this before, but I've always used my spreadsheets. I love spreadsheets. Chris knows that, spreadsheets run the world with my world anyway. But what we've done is we've taken the logic from these spreadsheets, we've taken our tools, and we've built it into a platform called the Vault. And what I want to show everybody is you don't have to be a spreadsheet person. We can now use the Vault as our operating system. So I'm in what's called the loan officer. And I just want for everybody that wants to kind of see how the math works, let me know if you have questions on this because there's a lot of stuff going on here, but we're in what's called the policy loan planning. And let's just say, for example, we're now going to take a $10,000 loan. And really what we're doing at this point is we're modeling. I'm not doing anything yet. I'm just going to model it out and see what would my payments look like, what would my interest look like to figure out what I want to do in terms of my loan processing. But let's just say I need $10,000 for something, and let's just use 5% as our loan interest rate. And remember in the buckets when I was showing you that, we have the ability to either add the loan interest to our balance or we can pay it annually. And so what some folks have been doing when they pay annually is they'll say, well, if my interest is going to be 500, let me just put, say $42 aside every month, and then I'll have the 500 at my policy anniversary and pay it. What I'm saying is if you have that $40 just sitting in a savings account, put it towards your principal and let the interest roll. But anyway, we can prove out that math if you want to do that. But that's what this feature is showing you is do you want to add your interest to the balance at the end of the policy year or do you want to pay it? Okay, so then we have our $10,000 loan amount at 5%. We want to make monthly payments. And so I can either put in a time, such as number of payments. What I want to do is say, I want to put, say, $500 a month towards this loan. But what I want to do first is I'm just going to say, you know what, I'm not going to pay it at all initially because I want to show that a $10,000 loan at 5%, if we go down to the payment table, You see that we have $10,000 here, and so the interest cost for that $10,000 this month is $41.67. We didn't make any sort of loan payment, so you see my payment is zero. Well, then next month I'll have another $41.67. So I'm just going to accumulate my interest. And what you're seeing here is this policy has an anniversary 6 months later, but the idea would be if I'm going through, and actually let me change the time here.
Hey, Craig, while you're doing that, listen, I want to say something that's really important. It's important for my companies, how we operate, and I just think it's important for every one of you. I am fed up and sick of companies directing everything to AI or a call center or some like random place you got to go and figure out how to talk to people. Like, how many of you just like to just talk to a human being when you first call about the questions you have? Because I mean, these chats are great, the questions are great, but some of you are thinking, watching this is amazing. I'd love to just get on a phone and have somebody like show my stuff, right? Because I've been really struggling with this a lot lately with AI and everything else. I just feel like we're losing the core essence of what makes a good company a good company. And I'm taking control of that back too. So we literally have people right now, Brian Fouts and Stephen Alonso, two of our mentors, waiting to take calls for any of you. It isn't a sales call. It's just a call to talk to you about your situation, about solving your problem, about paying your debts off, about the infinite banking concept. So the thing I want to let all of you know is that from today forward, and I'm making this commitment publicly, I'll do this every single week. We are going to have people that you can talk to every single webinar. And in the future, we're going to have somebody you can talk to with no more than 3 clicks. You just got, we got to do the 3 clicks because like when you call, we got to know, do you want to talk about infinite banking? Do you want to talk about private money club? Do you want to talk about the advisory? We just got to know who to put you on the phone with, and then you're going to have somebody to talk to. And I'm making a firm commitment that my companies, our companies, are going to be that way in the future. You're not going to talk to AI ever. You're not going to have to talk to a computer. You're not going to have to get bounced around. Hell, if you don't want, you don't even have to click the link to book a call. You can just talk to somebody. Is that cool, folks? It's a huge commitment. It's an expensive commitment, but this is what I want in my life. And this is what I'm going to bring to all of you. So Sean is going to put the numbers up there. If any of you want to talk to Brian or Steven, just call the number or call the number when we're done with the training. They will pick the phone up. If they don't, they will call you right back. This is our commitment to you for the future. Sorry, Craig.
Now, Chris, I know you and I have been talking about this, and I don't know if we have any ranchers on or anyone that knows the cattle industry, but there's a common term where the cows got AI'd. Cattle get AI. What that means is artificial insemination. And I was thinking, well, we use AI. The cows get AI, but it's a completely different experience. And then I thought, well, is it a completely different experience? And so we want to use AI for optimization. We don't want it to ever take place of that human touch, like what Chris was talking about. So that's what really comes to this. So it's just kind of funny. I was thinking about that this morning. I have this weird sense of humor. But anyway, I want to get back on track now. If I fix this little issue out, it should be a little cleaner now. We're just to reiterate, we're taking a $10,000 loan at 5%, and we're not making any payments. So I want to show this as kind of in building blocks. What does it look like if we take a $10,000 loan and throughout the year we don't pay it back? Well, that means you'll see here in this payment column, there's nothing being paid. We have a $10,000 balance at the start. We have a $10,000 balance at the end. And so that proves the point that our balance is not growing, but the interest is getting accumulated. Month one, $41.67. Month two, we add another $41. So now we're at 83, and then 125 and 166. So at the end of the 12th month, let's say this is our policy anniversary. Because it was a 5% loan interest, we have $500 of interest, don't we? And so what I can do is I can say, well, what's going to happen to that $500 if I don't want to pay it? Well, it gets added to our principal balance going into the next year. So now our principal balance is $10,500. Our interest cost now is 43.75, not 41.67. So hopefully everybody's seeing what happens if we take a loan and we don't pay it, we don't pay the interest, it gets stacked on. And so that's just going to continue on and on. Okay, so now that we've done that, let's go back and say, all right, well, I want to pay $500 a month back towards my loan. So this says, well, you should pay it off in 21 months at that rate. So the first thing is it says it's a 5% annual percentage rate. We're actually effectively only paying 2.33%. And it's because of that math that's going on where our interest cost for that $10,000 was only $407.08, not the 500. But what does that look like? So now you see we have in our payment column a $500 payment for the first 12 months, and our balance goes down by $500 every month, which then means our interest, remember it was $41.67, and because we bought that principal down, it's $39.58, then it was 83, now it's 77. So this is proving the economic benefits that you can actually be more efficient by paying your loan and paying it back faster. So here's the end of the year where we don't have a $500 policy loan interest. We have $337.50. Not 500, but $337.50. And so now what we're going to do is take that 337 and roll it into the balance and then just keep going. So that's kind of how we operate the loans in most cases. And the nice thing about this is you don't have to be a spreadsheet wizard. You can just come in here and type in the numbers, and maybe instead of a payment, you want to say, I want to pay it off in 5 years. Well, it's 189.02. And you can kind of see the math down here below. So, Chris, were there any questions or anything we need to address before I go
Yeah,
on to the next
two
step?
things. Somebody's asking, do we have anybody fluent in Spanish? Yes, we do. I'll have to have Shauna look up their number and give me that. But how about this? So NN Molina for Spanish. How about for everybody? If any of you want us to give you a call to talk through any of this stuff, and it can be any of this stuff regarding IBC, then send me a message in either the chat or better yet, just send me your phone number and email in the Q&A, and then I'll hand it off and they'll give you a call. So we definitely have people that speak fluent Spanish, no problem there. But if you, Stephen, Brian, both English fluent, I think Stephen might even speak Spanish, but nonetheless, send us your phone number and email in the Q&A or the chat. Just send it direct to me, and then I'll have them call you. I think that's just the easier way. Sorry, this is the first time we're doing this, so I'm trying to think what's the easiest way for those of you that want to chat for somebody to get a hold of you. And we'll be respectful that you're probably going to finish the training, but we'll send you a text and ask when's a good time to chat. And then you can just let us know. So no computers, no AI, just you and one of our money mentors.
The next step I want to take is I'm going to go back to the 500 on here just to keep the number similar. What we would then do as we're planning out our loans and figuring out how much we want to take, what interest rate, then we can go and pick our policies. So if you have a policy or multiple policies, we can actually, let's say I needed 100,000. Well, I might need to take some from this policy, and this policy. I might need 3 policies to actually fulfill that loan. But in this case, I'm just going to grab one and select my policy. What that allows me to do is to go over this personal loan planning. Now, if you've read The Infinite or Becoming Your Own Banker by R. Nelson Nash, or you followed this process, what we're talking about when we take a loan, if our policy loan is 5%, it doesn't necessarily mean we should pay it back at 5%. Has anybody read the Becoming Your Own Banker and specifically the equipment financing model that's on page 51? If you have, just put I in the chat. I just want to know if there's some folks out here that are familiar with that. So Ricky, good job. Awesome. The whole concept of that exercise that R. Nelson Nash went through was to say, if I'm going to finance trucks, he was, financing these logging trucks. He went and looked at what traditional financing would be. And let's just say that truck was going to be $50,000 at 8.65%. Well, what he did is he said, well, if I'm going to pay 8.65% and come up with a payment number, and that's what I was going to pay that financing company. Well, I'm going to pay that back to my system. And I'm going to show you in a minute what happens because this is a common question is, oh, wait a minute, Craig, if I'm paying my policy loan back at 8.65 and I have to pay for 60 months, aren't I going to pay that policy loan off and still have money? Absolutely you are, and I'm going to explain where that money goes. But just for now, hold that concept. What we're going to do in our personal loan planning is we're going to say, I'm going to take this loan, but I'm going to pay it back at 8.65%. Well, that means my monthly payment now is $548.27. Now, we're using a policy to take that loan. And remember, we're using the life insurance company's general fund money for that 10,000 while our money continues to compound and grow. So aren't we going to have compounding going on while we're leveraging this and paying the loan back? So what we're trying to do with this policy loan planning piece is to show you, all right, well, over that 21 months, how much premium did you actually put in the policy? Now, this is a brand new policy, so it's not going to be as efficient as if we were 3 years or 5 years. I'm going to show you what that looks like. But if we put in $10,000 of premium and our policy cash value grew to $10,136.69, this, my friends, is the opportunity cost because even though we use that $10,000 to go buy a tractor or to go, buy the windows or doors or whatever it's going to be, we still compounded. We didn't lose the opportunity cost, did we? I just showed it right here. We put in $10,000 and that $10,000 kept growing and now it's 10,136. But you might say, well, you had to pay interest. Well, we did. We paid a total of $408.42 to the insurance company. But because we're treating our system the same as we would a traditional financing system, we actually paid our system back $1,513. What happens to that difference? That goes into premium. Why would we put it in that premium bucket? Remember back here, if we've paid the life insurance company's bucket back and we still have loan payments to make, it's going into this bucket. The reason we want it going into this bucket is because it will now add to the amount that's compounding and growing. Isn't that beautiful? So that was that money that overflow is what would have gone to the bank, would have gone to the financing company. But now it's in our premium deposit bucket, compounding growing for the rest of our life. That's the beautiful thing about it. So when we look at this planning, we know that the profit just on the interest arbitrage or that spread. Remember, Chris talked about the banks. You put your money in the bank, they loan it out for more. They're making a spread. You, just like a bank, made a spread. You put
Hey,
that
Craig,
money right into the premium bucket, and now it's going to compound and grow for the rest of your life.
I know you covered this, but somebody made a comment on this. I just want to hit on this is because you are the bank, folks, because you are in control, you pick the loan repayment amount. You pick if you want to change that loan repayment amount. Heck, maybe you have a bad month and you want to stop that loan repayment amount. Like you are fully in control. If you got a home equity line of credit, which is what I alluded to earlier, you don't get to pick. The bank tells you how much your monthly payment is, and if you don't make it, you're in default, and then all of a sudden you're jeopardizing your house. Here, there is no default. There is no risks of you being, picking and choosing how much. So again, back to those things that I mentioned, the control aspect, like this is what we're talking about. Like it is the ultimate control in efficiency.
Yeah. And it's, to Chris's point, you lose a job, you have a couple bad months. Well, you don't make the payments to the insurance company, they don't care. Then you just get back on track. So would you rather have the bank financing your car or would you rather be financing your car and you have a couple bad months? Well, the bank isn't going to give you any leeway. They're coming to get your car. If your system doesn't get paid back for 2 months, who cares? So that's when we talk about control. And we always want to do the math because there may be some cases where you might think, hey, if I can get a 0% over here, I might do that for a while. But there's decisions to be made. But the point we're making is you're in control of this transaction. Your money is not lost in opportunity cost because it's growing and compounding in the policy. while you're paying back the same amount of payments you would have otherwise made to a bank. You're keeping that interest spread and you're putting it into premium if it fits. So when we look at all the ins and outs, just think of a bucket. Everything, premiums went in, money came out for the loan, interest payments and principal payments went back in. At the end of the day, this is what I look at is this recaptured number. So you see that 101.3 for this particular transaction for this $10,000 loan I took while my policy was growing. I actually gained $1.01 in my system. I didn't lose any money. And if I look at traditional financing, my choice is if I would have financed that $10,000 at some third party financing system and paid the 811, I would have lost $10,811.89 for my family forever. That would have been, this money would have been gone. So the choice is, would you rather lose 10,000 or would you rather recapture $1.01 for every dollar you put in? So now let me show you one other thing. I'm showing you a policy that's brand new. And for anyone that's kind of followed us for a while, you may know that there's a cost of insurance. So we're not always getting a dollar for dollar at the very, first couple years. So I started my loan March 18th of 2026. Time's going to pass. You're going to buy another car. You're going to have more home improvements. Let's just say we're going to bump this out to the year 2030. So we're jumping ahead a few years. What does that look like? Well, our compounding machine is growing faster and faster. Remember, it was just a little over 10,000 what we gained before. Well, now we put the same 10,000 in over that 21-month period, but we gained $12,859. We're now recapturing $1.27 per every dollar. So do you see what's going on here? The longer the system runs, the more mature it is, the more compounding we have, the more we're recapturing, the more efficient our banking system becomes. And let's do one more. Let's push it out to 2040 just to, jump out another, say 10 years and see what happens. We put in 2,500 because our premiums dropped off, but yet we still grew to 12,269. We're getting $4.35 back for every dollar we financed. Look at the long term, and this is what we always talk about in this process. We have to think long range. We have to think long term because this system requires time and compounding because compounding loves time and it just gets better and better and better over time. And guess what? I have to tell you, time's going to pass anyway, so why not put yourself and your family in a better position to do this? Instead of losing this every time you borrow 10,000, you're making this. So that's the decision we all have before us. Are we willing to give up a little something to gain something much bigger in the future? And that's really what we're talking about here. So let's see. If you have any questions, please put them in the Q&A. Let's see. Irv is asking, I'm lost if you can use this with retirement income vehicle similar to an annuity. So Irv, that's a really, really good question. And I'm going to just jump into, just to answer that, I want to show you something. So this is what we call a cash value analysis. And this is just based on a particular policy. And yours could be completely different. The amount you put in it could be completely different. This is why we say they're specially designed. We engineer them to achieve the problem you're trying to solve. But let's go down to, let's say someone was putting in, a dump in, and then they put in 6,265 every year. Let's just go down and look at, say, at age 70. This person's now 22 years into the policy. They're 70 years old and they have $258,000 of cash value. So Irv, what I want to talk about is in the previous 22 years, none of this compounding was impacted by the fact that I took a loan to go buy a car and then I paid it back. I took a loan to do some home improvements, then I paid it back. And so think of this as a system we're using and repaying and using and repaying throughout our lives. But when we get to retirement, and Chris has a really, really good video series on retirement income, and I'll get the link and post it here in just a moment. But think of this 258, that's available for retirement, supplemental retirement income. You can take withdrawals, you could take loans. So there's different ways we can get this money out. Now, what that's going to do is if we start doing withdrawals, that's going to lower this death benefit over here. But look, at the end of the day, if you're trying to use this for supplemental retirement income, think if you have an IRA or you have an annuity. Your annuity's got a guaranteed income, let's say for your whole life, and then maybe you have an IRA that's in the market. Well, guess what? When the market's down, we're just going to take our required minimum withdrawals. We're not going to take any extra. We're going to come over to the whole life policy and take our money from that. Market recovers, we quit taking from the whole life policy and we start taking back from our IRA. So it gives you the ability to kind of take from different buckets depending on market conditions, and that's called the volatility buffer. But I'll get that video, and Irv, if you want to watch that, I think that'll answer a lot of your questions about how this can be used for retirement. It's awesome to use for retirement, but just think about all those years before retirement, we're using this as a financing system. So anybody that's interested in that whole retirement series, talking about this whole concept of the volatility buffer, hit that link, save that link, watch the video. It's frankly one of my favorites because it's so powerful looking at how you tie in whole life with volatile things like the stock market. And then you can even layer in annuities with what we call a covered asset. So, Irv, think of the annuity, and here's kind of the way I sort it out in my mind is what do I need with Social Security, annuities, guaranteed income type of strategies? What do I need to cover my basic living so I have a place to live and I have food and clothes and transportation? So you come up with that number, and we want to solve that with annuities and guaranteed income, Social Security, and whole life can be part of that, but that's what we call the covered strategy. The volatility buffer is the whole life working with your market-based products where you can shift back and forth between the two. When the market's down, I'm taking from my whole life. When the market's up, I'm taking from my retirement accounts.
Yeah, Craig and Irv and anybody else who is kind of thinking retirement and like that's top of mind. I got to tell you, like that is a must-watch video. It's
Mhm.
not even an optional video if you're concerned about your retirement, the volatility, running out of money, any of the risks that come along with retirement. This video, I mean, it's a bit long, but it was based on pure science and pure mathematics done by Wade Pfau. It's if everybody that is planning for retirement just applied that strategy, people would not run out of money. People would not have these big variance in their income streams in retirement because of the market swings. People would literally just live a much better retirement life with a lot more security. And I'm not over exaggerating here. I'm probably understating the facts of this video. It uses things that are so vital and simple, but yet no advisor is teaching that. I don't know why. I don't know why advisors aren't teaching it. Maybe just because it's extra work for them to do, but it is a literally, I don't want to say a foolproof system, but it's about as foolproof as you will ever get for your retirement planning. So please watch the video. There's nothing you buy from the video. I mean, if you want help with the policies, clearly just you know who to call. Give us a call if you want help with the annuity strategies and setting up the annuities that can run the income part of it. We do that as well. We just don't go out there boasting product sales. That's not what we do. We teach concepts. We help people set up strategies and systems that work to solve their problems, which is very different than somebody pushing a product, which is unfortunately, I'm sorry to say this, what most advisors are doing these days.
Yeah, and I'll put my money where my mouth is on that conversation because my mom, when she was in her later 60s, she's now 82. We've had her in two guaranteed income, annuities, deferred annuities, but now she's got the lifetime income riders on those. So Social Security, two lifetime income riders coming from annuities. Plus she has a whole life policy, not really much in the market. And we also have her in a HECM, which is a home equity conversion mortgage, reverse mortgage. Man, she's just been doing great with it, and she doesn't really have to worry about the ups and downs of the market because her guaranteed income's covered. And anyway, it's been a phenomenal thing to see, played out now that she's 82. It's still working awesome. But these strategies, I agree with you, Chris, so much that these are the strategies that people need to know. These are the things that people should be doing as opposed to just spinning it all on the market. And
I
that's
did want to hit
unfortunately.
on one comment that somebody put in the chat. It says, "Who needs advisors when we got the you guys?" Which referring to us. Thank you so much for saying that. But I do want to preface that advisors are still very important, but in a different capacity than what you're thinking. Because you're right. You know, if advisors don't know, there's no trust. And what do you need advisors for when you learn this stuff? Well, here's what you need advisors for. And this is what, PMC Wealth does, Stefan and Brandon over there. Like that's an advisory firm that is set up completely different. People need to know how to get advice on their 401ks, which most advisors don't give advice on the 401ks because they're not getting paid on it. Unless they're the one that set the 401k up, good luck getting most advisors to give advice on a third party 401k. It's additional liability and risk for them, so they typically won't. But the other thing that a lot of people need financial advice on, and this is really important. So if any of you invest in real estate, maybe you're doing private lending, maybe you're investing in syndications or any type of what we would call alternative investment, which is an investment not traditional, which is not stocks, bonds, mutual funds, ETFs, things like that. So alternative investments. There are a lot of advisors out there that will give advice on alternatives, but there are very few specialists, and there are very few specialists who will do it at a reasonable cost or like a retainer-based cost. So the guys over at PMC Wealth, that's what they do. They will literally look at your alternative investments. They will look at, does gold fit? Does silver fit? They're not just trying to get you to move your assets over. And this is a huge thing. When I was a financial advisor, my number one goal was, if I met with you, you have to move your assets under my management so that I can get paid my management fee, and then I'll give you advice. With Stefan and Brandon over at PMC Wealth, that is not the case. They're not going to ask you to move your assets. Now you can if you want, they'll manage them in Schwab, but that isn't what they're asking. They're going to just give you what it's called fiduciary advice, pure holistic fiduciary advice on your investments, your 401k, your alternative investments, everything and anything you would need advice on. They're going to help you with that. And they're also going to help you get a better return on your cash, like your bank accounts. So that's what they do really, really well. We have them on this show every once in a while. Stefan's a savant is the only word for it. He's just absolutely beyond brilliant. So if any of you ever needed advice on that, but I just want to let you know that there is a need for advisors, even though we do such a good job. And thank you for saying that. There's still things that we can't give advice on. And that is one of them. Warren, I haven't forgot about you, buddy. And I guess right now would be a really good time. Craig, if you want to hit TC and anonymous, but I want to hit Warren's because Warren was asking, Warren, you were talking about the One America one. So I'm just going to read this question, but I want to go one step further for Warren because he asked a question earlier I want to hit. He said, with One America, if I pay the loan on the 11th month, so let's just say he takes a loan month one, and then he pays the loan back on the 11th month, will I be charged the same amount of interest as if I paid that same total amount, but sent it in each month instead of the 11th month? This is, I know that might be over someone's head, but this is a really important. I've answered this 3 times today in the chat. And Craig, you have the math to show this. I don't know if you want to take this, but yes, there is a very small mathematical advantage to making those monthly loan repayments versus one loan repayment. And it's just math. It's not some math, it's nothing other than mathematics. Craig, do you want to just kind of explain that to Warren? And then I got one more round for Warren that I got to show him.
Yeah, in Warren, it really just comes down to think of the way the interest is getting accumulated. It's based off of the principal. So the more we can reduce the principal and the earlier we do it, the less the interest grows throughout that year. So what One America is saying is if you take a $10,000 loan at 5%, they're going to charge that $500 up front. If you pay that loan off at month 11, they're going to prorate that interest so that you're not paying that full 500. But throughout the year, if you're instead of waiting until the end of the year or right at the 12th month, whatever principal reduction you had made, that interest is going to be accumulated. But it's better to pay that principal early and as much as you can. That's going to reduce the interest cost. So it's really just as simple as the faster you pay it off, the less interest you're paying to the insurance company.
Absolutely. Simple.
But they will prorate that interest cost, so you're still not going to pay the full interest cost,
And
even
Warren,
though they're showing it.
Warren had asked a question earlier regarding to like a trust and all that. We don't need to get into those details, but effectively, like what we were saying earlier is, you're borrowing against your death benefit up to the amount of your cash value. So let me just use some simple numbers here. I'm going to do it on the screen. So let's just say somebody had, well, here, I'm going to just keep this simple. I'm going to do it $10,000. Somebody had $10,000 in cash value. The insurance companies, most of them will allow you to use, and I'm just going to write 90 to 95% of your cash value. So if you have 10,000 in cash value, they're not going to let you take 10,000, but let's just keep this at, they'll allow you to use 9,000. Could be a little more than that, but just for the sake. This money gets deposited within your bank account. Usually it takes 36 hours or less. Okay. Just so you know, the time from the when you go online and do the loan to the time it hits the account is that. Now, in this scenario, let's just hypothetically say the death benefit on this policy is $500,000. Now, I'm not saying it will be or not. There's a lot of factors. Just giving an example. You have a $500,000 death benefit. When you do this, the insurance company is going to go in and do an entry in the system and subtract $9,000. So you'd have $491,000 in net death benefit the day you take the loan. So you use this, you pay off whatever, you pay off your credit cards, you start recapturing $500 a month because you paid off $9,000 in credit cards, and that money's coming back over here. So I think we already explained how the $500 a month would work, because every month, $500, if you did it that way, is coming away from the 9,000. So month 2, the insurance company would be charging hypothetically 5% interest on 8,500, not 9,000, which is less. So every month you pay $500 back to the policy. This 500, that is yours. That is in your account to use. That also every month increases your death benefit. So just trying to explain. So there's several moving parts, but they're all interconnected. The loan is being paid down, meaning the insurance company is charging interest on a declining balance. Your cash value is continually climbing. So 10,000 is worth more the next day because of the compounding. The $500 repayment also gives you more liquidity in your policy because it's dollar for dollar. Plus it's adding back to your death benefit. Now, if you died month 2, the death benefit of $491,500 in this example, because you made one loan repayment, would be paid to the trust beneficiaries of the policy. So there's never going to be a time, Warren, this is more for you. There's never going to be a time where you would have less death benefit than cash value. It cannot happen. And I'll just give you a quick, scenario of that. But anyway, so like here in this one, you put 10,155 in, you have a death benefit in the first year of 164,770. So we designed this for high cash value, so it has a lower death benefit. But you can see there is never a time as your cash value grows. Let's say your cash value goes from 164 day 1, and now 10 years later, your cash value is 101,000. Your death benefit is 237,000. See how your death benefit went up in conjunction? It's not dollar for dollar. Dave Ramsey would, for surely bash me if I said, oh, your cash value increases your death benefit, but it does. It's more of a component of the dividend buying paid up additions, but it's just a mathematical thing. As your cash value increases, your death benefit also increases. This is a unique feature of the policies we design and of whole life insurance. This is not the guarantee in universal life or IULs. So I wanted to just show that because that kind of just shows you the actual numbers. So hopefully that answers your question, Warren, because it was a very good question and I wanted to make sure other people heard of it as well. Craig, do you want to bring us home on that one?
Yeah, there's one other question we have in the Q&A. I thought maybe you could to address this from Mark. He's asking why One America does not announce their annual dividend like Mass
Oh,
Mutual and others.
well, I'm going to give you 2 takes to that, Mark. Now, they say, okay, One America says it's a competitive advantage because nobody knows their dividend. So therefore, like that's a competitive advantage because they're not playing the dividend game. I hate it. And I complain to them every single year. I will be out with them in they got 2 events. I'll see them and I will complain again. I will tell their CEO, who I know very, very well, great guy, Dennis. I will tell him, you guys gotta figure out how to declare your dividend because everybody else is doing it. Everybody else is using it. You guys think this is a competitive advantage? This is not a competitive advantage because from the street, from how Mark or anyone else looks at it, they think you're trying to hold something back, which they are not. Their dividend is very strong, and you get that when you get their annual policy statement sent out. Their dividends are really good, but they for some reason have it in their mind that that's a competitive advantage, which I agree with you. It is not. But when you run the numbers of One America versus the other carriers, they are very competitive. And I got some other news. I probably shouldn't say this. One America and a couple of our other carriers are about to have a full overview of their products, and it's going to be really good. So that's coming. And you said something, Mass Mutual. I got a bone to pick with Mass. I don't do that publicly. Maybe I shouldn't, but Craig, can you just make sure that like Irv and Unanimous, their phone numbers get over to the mentors there in the Q&A.
Sure.
But Mass Mutual, I have a lot of Mass policies because I'm in New York. So they're one of the companies that write in New York. Mass is a great company. They're a very strong company, been around a long time. They've got the highest dividend crediting rate. But here's my problem with Mass. Mass might boast the highest dividend crediting rate, which is 6.6 today, but it doesn't mean anything. If I compare Mass with Lafayette Life, which is a 5.9 dividend crediting rate with Lafayette and a 6.6 with Mass, it's not a lot of times Lafayette beats Mass. And you would be like, well, how can that be? Mass pays a higher dividend crediting rate. It all comes down to the second layer. They can pay a higher dividend crediting rate, but their internal cost structure on their cost of insurance and other, term riders and that are higher. So you got to be careful of playing. And this is what, Dennis and One America always says is don't believe the dividend game. And they're right, because it's kind of a bit of smoke and mirror. But the math is the math is the math. That's why the vault is so vital, Mark. The math comes out in the illustrations and in the vault. So it doesn't matter if Mass says 6.6 and Lafayette says 5.9. We're not playing that game. We don't care. We're not saying, oh, well, Mass has a higher dividend than Lafayette, so you should do a Mass policy. We don't use that. What we do is we go right into the mathematics. Hey, listen, this policy from this company solves your problem the best way mathematically. And that is how we measure success from carrier to carrier. And that is why we never just say, hey, we're going to run you one company. We usually will run two companies and show you two comparisons, and you pick and choose which one you like. And we'll kind of guide you. We'll say, hey, based on what the vault shows, this one's the best solution for your situation. So it's a great question, Mark. But I think a lot of people make the mistake of playing that dividend game and going and chasing the highest dividend. The other thing you'll find, if you look at Mass Mutual's dividend history versus Lafayette, it's a way more volatile. Like they might have the highest, but they also might have the lowest later. We're the carriers we deal with, Lafayette, One America, even though they don't declare, you can figure out what their dividend is, reverse engineering. They're all real steady. Like they don't have the wild swings. I love Guardian. I love Mass. They're great companies, but they do have a little bit of a wild volatility in their dividends because they're always chasing one another. It's like, oh, hey, Mass just increased their dividend, so Guardian increased their dividend. And it's kind of this game. But at the end of the day, if you just do the math, which is what we do for all of our clients, it's what the vault was designed to do. It's why every client scenario, and all of you that are giving us your numbers, we're going to use the vault. Okay, it's going to be it's going to be what we're going to use to solve your problems. That shows you the true economic mathematic benefit to you. That's all that matters. So, folks, this has been awesome. Craig, did you have anything you wanted to say in the end?
No, there's a lot of questions, or someone posted in anonymous, just like how I'm trying to get up to speed. I'm a little bit lost. What are some of the resources that we have? And on Chris's YouTube channel, there's a playlist called Wealth Webinar, and what we have 338 sessions that
Yeah,
we've
there's a lot.
done. So there's no shortage of content. So if you go to Chris Naugle's YouTube channel, there's a lot of content. Look in the playlist and look for the wealth webinar, and you're going to see all of the previous sessions. So there's lots of content we have out there. We have books, we have lots of fun things to dig into there.
I just gave Unanimous a video that's a really good one. Unanimous, sorry, I'm calling you Anonymous. I just don't know your name. That video is kind of like the best fundamental baseline video you can watch. So before watching anything else, that one I just sent you, just copy and paste it, watch that video, and that'll really give you the best shot of understanding like the core fundamentals of everything we talked about. And also this webinar we just did, which will go live on my YouTube channel Saturday, the very beginning where I went back to the basics, that, I mean, maybe I'm wrong. Actually, let me ask all of you, did all of you that watched it enjoy, it was a little longer than I hoped, but enjoy that fundamental explanation of IBC? Was that good? I'll get better at it, I promise. But was that helpful? I'm going to take, okay, Frank always, you know, he's always our supporter, but all right. So we got a couple people that are saying, yeah, I'll get better at it, I promise. I think it was a bit long, but that was my first run at it. And, you know, we're going to do that every single wealth webinar as the intro. We're just going to kind of hit the basics, and we're going to move on to the deep dive and what we're talking about, which we did today with loans. And this is such a great topic. And I'm really glad the comments came in the way they did. The questions came in the way they did. And listen, we're like 6 or 15 minutes over, and we're still getting comments, which is phenomenal. So thanks everybody so very much for joining us. Thank you for giving us your time. For all the first timers, thanks for joining us. And please don't let this be the last. For all of you that have been with us 2 or 9999999 times, we will see you next week and be very honored to share and teach and to show all of you how to take control of your money and how to be the bank. With that being said, we'll see you on the next one.